Welcome back, everyone, to the Deep Dive. This time, we're really diving deep into something a lot of you have been asking about, investment strategy. And to help us out, we're going right to the source, John Bogle's Common Sense on Mutual Funds. We're going to unpack the wisdom of the father of passive investing himself.
His ideas are more relevant than ever. This should be a great deep dive.
He founded Vanguard, right? That's incredible. But he was known for being a huge advocate for index funds. What exactly did he have to say about those? I'm hoping we uncover those interesting aha moments, those moments that can change the way we think about investing,
Absolutely. One of Bogle's core principles is that simplicity is key to successful investing.
That's interesting. Isn't investing supposed to be complex?
You'd think so, right? But he makes the argument that all that complexity, it often benefits Wall Street more than the average investor.
I'm intrigued already. So why is all that complexity so costly for us normal investors?
Bogle actually points out that actively managed funds, the ones that promise to beat the market, they can actually eat into your returns in three main ways: fees, portfolio turnover, and taxes.
I understand how fees work.
Okay.
But what exactly is portfolio turnover, and how does that cost me money?
Imagine a fund manager is constantly buying and selling stocks, always trying to predict the market and pick the next big winner. This constant activity, that's called high portfolio turnover. Every trade has transaction costs. Those costs might seem small on their own, but over time they add up and they can significantly reduce your overall returns.
So it's not just about picking the right stocks, but also about minimizing the cost of all that trading, right?
Yeah, exactly. And then there are the tax implications too. When a fund sells a stock for a profit, that gain is taxable. So the more actively a fund is traded, the more potential tax liabilities you'll face. Bogle argues that sticking with a simple, low-turnover strategy can really help minimize these costs and keep more of your hard-earned money working for you.
That makes sense.
Yeah.
It's like choosing between two runners. One sprints and bursts and uses up a lot of energy. The other one keeps a steady pace, conserving their strength for the long haul.
Yeah, and in the long run, it's often that consistent, steady approach that gives you the best results. Bogle was really pushing against this idea of trying to constantly beat the market. He was arguing that for most investors, capturing market returns efficiently is a much more realistic goal. It's more achievable, too.
It leads it to index funds, right? He was a big fan of those. I have to admit, though, I've never been clear on how they actually work. They track a specific market index, like the S&P 500, right? But isn't that like settling for average returns? Don't I miss out on the chance to invest in individual companies that could really take off?
That's a question a lot of people have. It's tempting to think we can pick those winning stocks and beat the market. But Bogle argues that consistently picking winners is really hard, even for the pros. And the data backs him up. Most actively managed funds, they fail to outperform their benchmark indices over the long term, especially after you account for fees and taxes. Index funds, on the other hand, they offer a really straightforward way to capture market returns without the guesswork and the high costs. They're basically buying all the stocks in a given index in the same proportion as the index. It gives you built-in diversification, and it minimizes the risk associated with betting on individual companies.
So in a way, I'm spreading out my risk across the whole market, right? Instead of putting it all in just a few stocks. But couldn't a good fund manager, one with a team of analysts, be able to find those hidden gem companies? The ones that deliver those huge returns. Isn't that what we see in all the ads?
Well, sure, there are always those stories of star fund managers, the ones that beat the odds. But Bogle, he argues that those stories are the exception, not the rule. And even if a fund manager does beat the average returns for a while, it's really hard to keep that performance going over the long term. Market conditions change, trends shift, and even the best strategies, even those can lose their edge.
So it's not about trying to find some magic formula to beat the market, is it? It's more about recognizing the limitations of active management and adopting a strategy that's designed for consistent long-term growth.
Yeah, that's a great way to put it. And Bogle's own flagship fund, the one that tracks the S&P 500, that fund is a testament to this philosophy. It's consistently delivered solid returns for investors. It proves that you don't need to you don't have to chase elusive outperformance to build wealth over time.
Okay, I'm starting to see the appeal of index funds now.
Yeah.
They're a way to be a part of the market's growth potential, right? Without having to be a stock-picking expert or pay huge fees to someone who says they are one.
Exactly. And it frees up your time and energy to focus on other important parts of your finances: saving, budgeting, and planning for the future.
This is really making me think differently about my approach to investing. I've always been intimidated by how complex it all seems, but Bogle's focus on simplicity, oh, that's refreshing.
That was his gift, really, making investing accessible to everyone.
So we've talked about the cost of complexity and the advantages of index funds. I know Bogle also had some interesting things to say about stocks and bonds, right? Like how our ideas about risk might be a little off. Can we get into that next?
Absolutely. This is where things get really interesting. Get ready to rethink everything you thought you knew about stocks being risky and bonds being the safer option.
Okay, I'm ready to be challenged. Okay, let's talk about this idea that stocks are so risky and bonds are so safe. It's like something everyone just assumes is true.
Hmm.
I'm sure Bogle has a different take on this, right?
He does. It might surprise you. Bogle actually uses data to argue that stocks have earned more than bonds over the long term. He even suggests that bonds could be riskier than stocks over really long periods.
That's a bold statement. I mean, I'm ready to hear what he has to say, but that goes against everything I thought I knew about investing. How could bonds, the safe haven, be riskier than stocks? Everyone knows stocks go up and down all the time.
Well, the key here is inflation. See, inflation erodes purchasing power, especially over a long time. Bonds offer fixed income. Let's say you buy a bond and it pays 3% interest, right? But inflation is at 2%. You're only making 1% in real terms. Your money is growing, but
Yeah.
you can't buy as much with it.
So inflation's like what, a hidden tax? It eats away at my returns, right?
Yeah.
So I'm getting interest, but everything's getting more expensive. My money isn't going as far.
Yeah, that's a good way to put it. And if inflation goes higher than the interest rate on your bond, you're actually losing purchasing power. Your money is increasing, yeah, but it's worth less. This is where bonds can be a problem, especially for people who are investing for the long term.
Interesting. So bonds might not change value as much as stocks, but their fixed returns mean they can lose value because of inflation.
Right. And that's where stocks have an advantage. They might be more volatile in the short term, but companies can usually keep up with inflation. They raise prices and their earnings grow. When you own stocks, you're basically a part owner of those companies. You share in their growth. And that helps protect you from inflation.
It's like the difference between renting a house and owning one, right? With renting, you know what you'll pay every month, but you're not building any value of your own. And your rent can go up. With owning, you've got those mortgage payments and maintenance costs, but you're building wealth, right?
Yeah.
And your property value will probably go up over time.
That's a great analogy. And it shows why Bogle says stocks, even though they're volatile, might be better in the long run than bonds. You have to think about inflation.
This is really changing how I see things. Risk isn't just about how much my investments go up and down every day, right? It's about how much my money will be worth years from now.
Exactly. You have to understand the different kinds of risk and how they work over different periods of time.
So does this mean we should forget about bonds and just put everything into stocks?
Not necessarily. Bogle still says it's important to diversify. You have to find the right mix of stocks and bonds for your own situation and your goals.
So it's all about finding that balance between stocks and bonds, taking into account my risk tolerance, how long I'm investing for, and what I want to achieve. It's starting to click for me now.
That's great. And then that actually brings us to another one of Bogle's key ideas, time. He says time is your biggest advantage when it comes to investing.
I get that starting early is good, but why does he focus on time so much?
Well, he says time is crucial for dealing with volatility and maximizing returns. Think about it. The longer you invested, the less those short-term ups and downs affect your overall portfolio. It's all about riding out those waves and sticking with your plan. You know that the market usually goes up over time.
So like sailing a ship, right? There'll be storms and calm waters along the way. But if I keep my course and my eyes on the destination, I'll eventually arrive.
Exactly. The sooner you set sail, the more time you have to navigate those choppy waters and let compounding work its magic.
Speaking of compounding, I know it's important, but I have to admit, I still don't really get how it works.
Compounding is like a snowball effect. You earn returns on top of your returns. Imagine you invest $100 and you make 10% in the first year. Now you have $110. Next year, you get another 10%, but now it's on that $110, not the original $100. So you make $11 in interest instead of $10. As time goes on, your returns are generating more returns. It grows exponentially.
It's like a tree, right? Each year it grows new rings.
Yeah.
But not just on the trunk, on all the rings that were already there. So the growth gets bigger and bigger every year.
That's a great way to picture it. That's why starting early, even with a small amount, makes a big difference over time. Your investment has time to compound, and that snowball really starts rolling.
This is powerful stuff. Investing isn't just about finding the right stock or bond, is it? It's about understanding how things work in the long run and making sure my strategy fits with that.
Absolutely. It's about shifting your mindset. Stop thinking about quick gains and losses and focus on the long term. You can ride out those market ups and downs and let time and compounding do their work.
Okay, so we've covered how stocks and bonds aren't always what we think they are, and we've talked about the power of time and compounding. What else does Bogle think is important for a good investment strategy?
Well, he actually dedicates a whole chapter to picking the right fund house. He says that even when you're doing passive investing, the fund house you choose really matters.
Interesting. Is it all about fees, or is there more to it?
Fees are definitely important, but Bogle says you should look for fund houses that operate, how did he put it, economically, efficiently, and honestly.
I get what he means, but how do you actually do that?
hmm
How can I tell if a fund house is really looking out for me?
You have to do your research. Look at different fund houses. Don't just go by the marketing and the fancy brochures. See what their track record is like, how they structure their fees, what their overall philosophy is. Bogle believed that the best fund houses put their investors first. They keep costs low and they're transparent about how they work. They really want to help people reach their financial goals.
So it's not just about picking the right investments, but also about picking the right people to guide you, right?
Exactly. And remember, you're not just investing in funds, you're investing in companies. And those companies have values, a way of doing things, leadership, and all of that can affect how they do and ultimately how your investment performs.
I never thought of it like that, but that makes a lot of sense. My investment choices reflect what I believe in and how I think companies should act.
That's it. It's something to really think about when you're choosing a fund house. Do their values match yours? Do you trust them to manage your money well and ethically? Those are important questions when you're building your investment portfolio.
This is so insightful. I feel much more confident now about making smart choices when it comes to investing. Choices that fit my values and my goals for the future.
I'm glad to hear that. That's what Bogle wanted,
Yeah.
to give everyday investors the knowledge they need to take control of their own finances.
Before we wrap up, did anything else stand out to you from the book? Something we haven't discussed yet?
One thing that really struck me was what Bogle said about leadership in finance. He believed that the whole industry had an obligation to serve investors, not just make profits. He really challenged fund managers to act with integrity, be transparent, and truly care about their clients.
It's inspiring, isn't it? He wasn't just a financial expert. He was pushing for ethical behavior in business. It's such a powerful message, especially in an industry where profits often come first. What an amazing legacy.
It really is. And his message isn't just for investors, it's for anyone working in finance or any industry, really. It's about leading with integrity, putting the needs of the people you serve first, and building businesses that create value for everyone, not just a small group.
What a great thought to leave our listeners with. I feel inspired to not only invest wisely, but to support companies and fund houses that are trying to do business the right way.
I think that's a perfect takeaway from our deep dive into common sense on mutual funds. Bogle's insights go beyond just investing. He gives us a framework for thinking about our finances, our work, and even our lives, really. A framework built on simplicity, integrity, and creating value over the long term.
We've covered so much today, from the cost of complexity and the benefits of index funds to how stocks and bonds actually work, the power of time and compounding, and picking the right fund house. It's been a fantastic journey.
We've only just touched on some of Bogle's wisdom, of course. If you're curious to learn more, I highly recommend reading Common Sense on Mutual Funds yourself. There's so many more insights and practical tips in there that can help you navigate the world of investing and build a solid financial future.
This deep dive has been so eye-opening. I feel much more prepared to take control of my investments and build a portfolio that matches my values and my long-term goals.
I'm thrilled to hear that. Remember, investing doesn't have to be overwhelming. Follow Bogle's principles, keep your costs down, and think long-term. You can achieve your financial goals and create a future you're proud of.
Thanks for joining us on this deep dive into John Bogle's timeless wisdom. We hope you found it as valuable as we have.
Until next time, keep learning, keep growing, and keep investing in yourself and your future.
So we spent the last two parts really digging into some of the core concepts from John Bogle's Common Sense on Mutual Funds. One thing that I still keep thinking about is what he said about bonds being risky over the long term. I mean, it just seems strange, right? Everyone thinks bonds are the safe investment.
It's definitely one of those eye-opening ideas from Bogle. He's basically saying that stocks, even though they're volatile in the short term, might actually be better than bonds for long-term investors. especially when you factor in inflation.
Right, and we talked about that a bit earlier, but I think it's worth going back to. Can you remind me again how inflation plays into all this?
Sure. The important thing to remember is that bonds usually pay a fixed interest rate. So let's just say, for example, you have a bond paying 3% interest. Now imagine inflation is at 2%. Well, that means you're really only gaining 1% in real terms. Your investment is growing, but it's not keeping up with the rising cost of living. Your purchasing power is being eroded over time.
So it's like, I don't know, I'm working hard, but not getting ahead.
Yeah, kind of like that. And what's even worse is if inflation goes above that 3% interest rate on your bond, then you're actually losing purchasing power. Your money is growing on paper, but in reality, it buys less and less over time.
I see. That could be a real problem, especially for people who are investing for decades, like Bogle recommends.
Exactly. Bonds can be a trap because they pay a fixed return. That fixed return makes them vulnerable to inflation, especially over a really long period. Now, with stocks, on the other hand, you have the potential to stay ahead of inflation. Companies can raise prices, they can grow their earnings over time.
So when you own stock, you're kind of like a partner in a company that's adjusting to the economy, including inflation as it changes.
That's a really good way to think about it. Stocks have their own risks, of course, and there will be ups and downs along the way. But Bogle's point is that over a long period, that growth potential of stocks and the fact that they can keep up with inflation might make them a better choice than bonds.
It's like I have to change how I think about risk. It's not just about the day-to-day fluctuations in the market. It's about how much my money will actually be worth years from now.
Exactly. It's about really understanding the different types of risk and how they play out over different time periods. Bogle wants us to see risk not as something to be afraid of, but as something that we can understand and manage.
This whole deep dive into John Bogle's common sense on mutual funds has been amazing. I honestly feel like I have a much better grasp on how to approach investing, how to think about risk, and how to make choices that will help me reach my goals down the line.
I'm so glad to hear that. You know, that was Bogle's whole mission. He wanted to empower people, to give them the knowledge and confidence to make smart financial decisions for themselves.
Well, we've certainly only scratched the surface. But for anyone who wants to keep learning, I highly recommend picking up a copy of Common Sense on Mutual Funds. There's so much wisdom in there, and tons of practical advice that can help you navigate the world of investing and build a strong financial future.
Couldn't agree more. It's a fantastic resource. And remember, investing doesn't have to be this big, scary thing. Just keep it simple, keep your costs low, and stay focused on the long game. You can achieve your financial goals and create the kind of future you're dreaming of.
That's a great note to end on. Thanks for joining us for this deep dive into the wisdom of John Bogle. We hope you got as much out of it as we did.
And until next time, keep learning, keep growing, and keep investing in yourself.